We will get started by talking about what accounting is. I want you to think about accounting versus accounting. In particular, let's pay attention to certain parts of the word. A lot of times when people think of accounting, they focus on counting, as in, I'm going to be working with numbers and I'm going to be working with math. But there's another part of the word, account. Account means to tell a story. Let's look at the Webster's Dictionary definitions of counting and account. Definition of count is to indicate or name by units or groups so as to find the total number of units involved, to count the pages of a manuscript, or to count to 10. The definition of account is a description of facts or conditions or events, a report or a narrative. For example, the newspaper account of a fire. By all accounts, they're well off. So in this class, I really want you guys to focus more on account. What we're doing in accounting is telling the story of a business. Accounting is how we collect economic information and place it into order so that we can understand it and use it to make good business decisions. Accounting is the language of business. So what accountants are doing, they're taking economic information and they're organizing it so that managers can make decisions for the business. Accountants are telling the story of what has gone on in the business during an accounting period. Some of you might be thinking, but isn't accounting math? Accounting is not math, but we do use math. The math that you will need to know for this class are elementary math principles such as rounding or decimals, and this is because we will be working with dollar values. And then also pre-algebraic equations such as how to solve for x and how to solve pre-algebraic word problems.
So far, we've been discussing what accounting is and what it isn't. The American Accounting Association, in partnership with the AICPA, have developed this model to help us define what accounting is. Every day in the business place, economic activity occurs. Accountants use their critical thinking skills to look at that economic activity, filter out the shades of gray, to apply accounting judgments to it. Then they can convert this economic activity into useful information that can be used by decision makers to make good decisions, which hopefully lead to a prosperous society. Of course, any decision a business makes will have consequences that will either lead to more economic activity or perhaps have to go through the cycle of accounting judgments and conversion to useful information again. Let's talk about this step. Who are the people making these good decisions? We call these our decision makers. They're the ones that need this accounting information. Decision makers can be internal to our company or external from our company. Decision makers inside of our company might be managers or our employees. External decision makers include lenders, shareholders, labor unions, the government, suppliers, customers, or donors. In Accounting 201, we are focused on creating useful information specifically for external decision makers. These individuals and entities, because they work outside of our company, they don't see what's going on a day-to-day basis. So accountants need to put together some reliable information that these people can look at and understand what's going on in the company in order to make decisions about or for the company. If you go on to take Accounting 211, you'll learn about information collected for internal decision makers. Okay, so what do we call this useful information that we make for external decision makers? We call these our financial statements. We have 4 basic financial statements: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. We'll talk more about those in just a little bit. In the meantime, we need to take a moment to learn more about corporations. You need to have a basic knowledge of what a corporation is and how it is formed to understand this class. The textbook we're using uses terms that deal specifically with corporations, so it's important that you have this understanding. I'll post a link to a short video explaining what a corporation is and how it's formed.
This is Julie. She lives in Paris. Julie is known for her delicious croissants. She started baking when she was a little girl, and ever since it has been her dream to open a bakery of her very own and supply the city with her wonderful croissants. She figures that it will cost her $100,000 to start her business with all of the supplies, staff, and costs of starting a business. The problem is Julie only has $10,000 to put into her company. She definitely can't build her business properly on $10,000. What is Julie to do? Julie decides to issue stock to investors to help raise money. Stocks are pieces or shares of ownership of a company. Each share is worth a certain amount based on what the company is worth. Companies issue shares to investors in order to raise money. Because she is $90,000 short, Julie decides to get 9 of her friends to invest in the remaining balance. However, to do this, Julie must give up 90% of her company in shares. Now Julie and her friends each own 10% of her company. 5 years later, Julie's bakery is booming. She has turned her bakery into one of the biggest in Paris. Her company is now worth $1 million. Julie got the money she needed to create her business without acquiring additional risk or debt. Also, Julie and her 9 friends each turned their $10,000 investment into $100,000. Just like Julie's friends bought shares in her company, you can also buy shares of publicly traded companies like Apple or Walmart. If Apple has 100 shares and you bought 1 share, you would own 1% of Apple.
Okay, so we've established that it's really important that accountants create useful information for decision makers to make good decisions for a business. So how do accountants do that? Well, that's a lot of what we're going to be learning in this class. We're going to learn how to filter out the shades of gray and apply accounting judgments to economic activity. In order to do that, accountants adhere to something called GAAP, Generally Accepted Accounting Principles. GAAP is a set of accounting rules that we're going to follow. There's 2 qualitative characteristics under GAAP, relevance and faithful representation. Accounting information must be able to affect the decisions of users in order to be relevant. Faithful representation means that business results have accurately been reflected in our accounting information. Now, who makes GAAP? Well, there's a governmental entity called the Securities and Exchange Commission, the SEC. They have the legal authority to set GAAP. Now, they don't actually make GAAP. They delegate that authority to another entity called the Financial Accounting Standards Board. Sometimes we call that the FASB. Did you know there's also an International Accounting Standards Board? Instead of GAAP, they make something called IFRS, International GAAP Rules. We won't be covering any international standards in this class. There are many, many GAAP principles, generally accepted accounting principles, that is. We're going to pick out of those that are most important to understand for this class, but you should read about all of them in Chapter 1 of your textbook. The first one we will discuss is the cost principle, also known as the measurement principle. That states that we're going to use actual historical cost when recording anything on our accounting books. Now, what do we mean actual historical cost? That's what we actually paid for an item. Now, there could be a lot of considerations when we talk about what we paid for an item, and we'll cover that later on. Now, what does cost not include? Well, any fluctuations in fair value over time. So, for example, perhaps you own a car. You paid a certain amount for that car. that car may not be as worth as much today as it was the day you bought it because it's a little bit older, a newer model's come out, maybe it has a few door dings on it. Well, we're not going to adjust our accounting books down for the change in fair market value of that car. We're going to keep it on our books at historical cost. Next is the revenue recognition principle. The revenue recognition principle states that revenues are recognized when the performance obligation is satisfied. Now, what's a revenue? Well, whenever we sell a product or a service and the customer gives us money, that's a revenue. But what if we've sold a product or a service and the customer hasn't given us money yet? Well, that gets tricky. We can still record a revenue if we've satisfied the performance obligation. So for example, let's say we have a bakery and a bride comes in and orders a wedding cake. And this bride, she's so romantic. Her wedding is going to be on February 14th on Valentine's Day. Okay. Well, she goes ahead and she pays us for the cake today. We cannot record a revenue yet because we have not satisfied the performance obligation, which is delivering that cake. So we've got some cash, but we don't have a revenue yet. We have something else. We have a form of a liability. We'll talk about that more later on. Okay, the expense recognition matching principle. The expense recognition principle, or the matching principle, states that expenses must be matched with related revenues. So, let's say we have bought a whole bunch of flour for our bakery, and we bought that flour in January. But we're not going to use the flour until we make the wedding cake for that bride in February. So we don't need to expense that flour until we have used it to earn revenue. So we're going to match our expenses with our revenues. Next is the full disclosure principle that states all relevant details of our transactions must be reported. The going concern assumption. The going concern assumption states that we are assuming that the business will continue operating. The monetary unit assumption. We're going to express our transactions in monetary units. So here in the U.S., we're going to use dollars. The time period assumption. Life of our business can be divided into time periods. Typically, we're going to use months, quarters, which is our time periods of 3 months, and years. The business entity assumption. This states that our business can be accounted for separately from other entities. So we're not going to include the manager's or the owner's personal financial information in with our business information. Okay, I've mentioned a word a few times. That word was transaction. What is a transaction? Well, a transaction is a business activity or event that can be reliably measured. It affects the accounting equation. Wait, what's that? We'll talk about that in a second. At least 2 accounts are involved, and the accounting equation must remain in balance. Okay, what is the accounting equation? The accounting equation is assets equals liabilities plus equity. We also mentioned another new word, accounts. What is that? We'll talk about that in just a moment. How do we know when a transaction has occurred? Well, we will have some form of source document. So a source document could include a sales receipt, an invoice, a check, a purchase order, an employee earnings record, or a bank statement.
Recall the basic accounting equation. Assets equals liabilities plus stockholders' equity. If you've taken an accounting course in the past, you may have referred to stockholders' equity as owner's equity. We use owner's equity when we're working with sole proprietorships and partnerships. We use stockholders' equity when we're working with corporations. The owners of a corporation are called stockholders or shareholders. Stockholders' equity can be broken down into as contributed capital and retained earnings. Contributed capital is the capital contributed by the owners into the company. So that might be things like cash or equipment. And in exchange for those items, the corporation gives the owners shares of stock. That is a share of ownership in the corporation. Retained earnings is the earnings retained in a company at the end of a period. Retained earnings can be broken down into net income minus dividends. Net income is the revenues of the period minus the expenses of the period. Let's talk about those account types. First up, we have assets. Assets are the resources a company owns or controls. There are many different types of assets. A couple of good examples of assets are cash, equipment, supplies, and accounts receivable. Next, we have liabilities. Liabilities are the creditor's claims on assets. We can think of this as the amount that the company owes to its creditors, similar to a loan. Then we have stockholders' equity. Stockholders' equity is the owner's claim on assets. As we said on the prior slide, stockholders' equity can be broken down into several parts. The first component of stockholders' equity is contributed capital. These are the owner's contributions to the company. Oftentimes we will call this common stock or preferred stock or another type of stock. We may also call it additional paid-in capital. Dividends are returns of the company's earnings to the owners. So at the end of the period, the company will look at how much money it has earned and decide whether or not to keep that money in the company in order to grow the company or to return something to the owners. Dividends can be in the form of cash, stock, or property. Revenues are the increase in assets from a sale of a product or service. And expenses are the cost of assets consumed or services used to generate revenues. You can read more about these account types in your textbook. At the end of a period, after all transactions have been recorded and accounts have been adjusted, accountants take the account types and arrange them into financial statements. The four financial statements are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. The first financial statement is the income statement. The income statement reports revenues and expenses. It shows how successful or not a business has been during the period. It covers a specific period of time. This is the skeleton format of the income statement. Revenues minus expenses equals net income. If expenses are greater than revenues, there could be a net loss. The brackets in accounting symbolize negative figures. Sometimes accounting uses red to symbolize negative figures as well. The next financial statement is the retained earnings statement. The retained earnings statement shows what the organization is doing with its earnings. Remember, we said that at the end of a period, an organization can decide whether or not to keep money in the company, to grow the company, or return something to the shareholders. The retained earnings statement covers a specific period of time. The skeleton form of a retained earnings statement looks like this. Retained earnings beginning plus net income minus dividends equals retained earnings ending. If it's a brand new business, the retained earnings at the beginning of the period will be 0 because there will not have been any retained earnings yet. The next financial statement is the balance sheet. The balance sheet reports assets and claims to those assets. The balance balance sheet will show whether an organization relies on debt or equity to fund its assets. Balance sheet covers a specific point in time. The skeleton form of a balance sheet looks like this. Assets equals liabilities plus equity. This should look familiar. This is our basic accounting equation that we have learned. The last financial statement is the statement of cash flows. This reports cash flows from the three principal business activities, which are operating, investing, and financing. This shows whether the organization has enough cash to fund its activities. Statement of cash flows covers a specific period of time. Skeleton format of the statement of cash flows looks like this. Cash flows from operating activities plus or minus cash flows from investing activities plus or minus cash flows from financing activities equals the net increase or decrease in cash. We add this amount to the cash at the beginning of the period, and this should match the cash at the end of the period. We will cover the statement of cash flows in depth at the end of the semester. There are examples of these four financial statements in your textbook. The full financial statements include many different categories under each account type represented. However, it's important to know the skeleton format of the four financial statements. This will help you get a better understanding of what's going on and the relationships between the financial statements. It will also help you answer your exam questions. Let's practice using the skeleton forms of our balance sheet, income statement, and statement of retained earnings. If liabilities are $90,000 and stockholders' equity is $230,000, what is the amount of total assets? We're going to use our basic accounting equation, the skeleton format of the balance sheet, to solve this question. I'll go ahead and give you the answer. The answer is $320,000. Well, how did we get this? Well, if assets equals liabilities plus stockholders' equity, we can fill in what we know and solve for what we don't know. The question tells us that liabilities are $90,000 and stockholders' equity is $230,000. Assets must be $320,000. We are simply solving for x variable being assets in this case. The next example is similar. If total assets are $160,000 and stockholders' equity is $60,000, what is the amount of liabilities? The answer is $100,000. Again, we're using the basic accounting equation, aka the skeleton form of the balance sheet, to solve this. Assets equals liabilities plus stockholders' equity. Let's fill in what we know and solve for what we don't know. We're trying to figure out what liabilities are. We know that assets are $160,000 and stockholders' equity is $60,000. We subtract $60,000 from each side, we're left with $160,000 minus $60,000 equals liabilities. Liabilities equals $100,000. Again, we're solving for x, except this time our x variable was liabilities. Let's change things up a bit. This time let's solve for net income. Net income is the difference between revenues and expenses. Revenues are amounts coming into the company because of sales of goods or services. And expenses are assets used to help us earn those revenues. Those assets used could be cash or could be other assets. Okay, so if revenues was $200,000 and expenses was $55,000, what is net income at the end of the year? Sometimes we think of net income as kind of like our profit. It's what's left over after we pay all of our expenses. The answer to this is $145,000. All right, revenues are $200,000 and expenses were $55,000. So that's how we get net income of $145,000. $200,000 minus $55,000. On this next example, we will be looking at retained earnings. The company began the year with retained earnings of 0, so this must be a brand new company. During the year, the company recorded net income of $75,000 and paid dividends of $5,000. What was retained earnings at the end of the year? Well, if we're looking for retained earnings, we'll use the retained earnings statement. The answer to this question is $70,000. The retained earnings statement is retained earnings at the beginning of the year plus net income minus dividends equals retained earnings at the end of the year. So if retained earnings at the beginning of the year was $0 and net income was $75,000, dividends were $5,000, retained earnings at the end of the year must have been $70,000.